The focus of the Federal Reserve in the first half of 2020 will be on the technical aspects of how overnight funding markets work, rather than the broad sweep of interest rate policy. Yet the shift to technicalities may have major implications for interest rate policy down the road and how long the Fed continues to target the federal funds rate. The shift away from attention to interest rate policy has been made possible by the solid, if not spectacular, performance of the U.S. economy. While real GDP growth may be hovering only around 2%, unemployment is comfortably below 4%, and inflation is just below the Fed's long-term objective is 2%. In this environment, the Fed signaled a halt to interest rate cuts in the fall of 2019 after putting its federal funds rate target right just below the prevailing inflation rate. This achieves one definition of a neutral monetary policy, a rough equality between short-term rates and recent inflation. Attention is now focused on the complex question of the role of the Federal Reserve in overnight money markets. The Fed targets the federal funds rate, which is the rate of interest banks charge each other for overnight lending when one bank has excess funds and another needs to finance ongoing lending programs. This is a small market, less than $100 billion of activity per day, and not necessarily very representative. The broader overnight money market is the secured overnight funding market, where asset managers and hedge funds access the banking system to fund their various security positions. They post Treasury securities as collateral to finance much more risky exposures. This overnight secured funding market trades a little less than $1 trillion per day, and it is much more representative money market conditions than federal funds. Indeed, the financial authorities have designated SOFR, Secured Overnight Funding Rate, as the preferred successor of LIBOR. So when SOFR spiked on the 17th of September to very high levels, if only for a day, the Fed took notice and decided immediately to provide funds to calm the overnight market. The longer-term question for the Fed, which it will debate in the first half of 2020, is how much loco imperatus is appropriate. Should the Fed take over the market and remove the credit risk discussion between counterparties? Or should the Fed make a hands-off approach and let the banks and the hedge funds monitor their overnight risk themselves, with all the natural market volatility informing the participants regarding the risk they are taking by not using term lending facilities? The reason the issue is so important to the Fed down the road is that the Fed may well consider abandoning the target of federal funds as too narrow a market and move to setting short-term interest rate policy based on the broader overnight secured funding market. This would be a major change for the conduct of monetary policy, and the degree of overnight rate volatility that seems appropriate to assess risk is the critical question facing the Fed as it enters 2020. I'm Blue Putnam, Chief Economist, CME Group.